In this video, we're going to work through 4 different examples looking at accrued income, income received in advance, accrued expenses, and prepaid expenses. So to back it up again, and obviously if you've watched the main video, you'll have a sense of what this is. But the idea is we're separating out when the activity happens from when cash moves. So from an income point of view, have you done the work? You might have received the cash already, or you might not have received it yet. From an expense point of view, you've used up the expense, but you might have not paid for it yet, or you might have paid for it before you used it. So those will have differential impacts in terms of the accounting. And with that, we're going to have a look at the 4 different examples from the text. In this first example, we're looking at accrued income. The facts that we have are that ATC conducts a holiday clinic for a tennis club on the 20th of December 2019. The club is invoiced $8,000, but as of the 31st of December 2019 had not paid. The financial year ends, in this case, on the 31st of December 2019. So importantly, between when they did the work and when they finally get paid, those will happen in 2 separate periods. So we're going to do this using the journal entries, but you can imagine what this would look like using the worksheet as well. So on the 20th of December 2019, we will have money owed to us. So accounts receivable, and that will be debit of $8,000 because it is an asset and they are owed money, so they reflect that. The entry for the credit side of things, and what we need to balance it out, is I've called service revenue. You could call it something different, but importantly, it is some type of revenue account. Accounts receivable is an asset. Service revenue is an income item ultimately affecting equity. So they have an asset increasing and they have revenue increasing. At the point in time later on where they finally get paid, they would show cash increasing, and let's assume they get paid the full amount, and they would show accounts receivable decreasing $8,000. Cash is an asset, accounts receivable is an asset. So at the time they get paid, again, this is the accrual accounting perspective. At the time they get paid, there is no income that takes place. All that you're doing is reducing this asset. The revenue is put in place in the year or in the period in which the service is performed. So ultimately what we end up with is accounts receivable and account receivable net out, and we ultimately end up with debit cash $8,000, credit service revenue $8,000, but it's happened over 2 different transactions at 2 different points in time. The second example is income in advance. In this particular example, ATC is commissioned in December 2019 by Tennis Australia to run a 4-week training squad in January, so in the following year. There is an upfront payment of $12,000, and the financial year end is 31st of December 2019. So the payment now happens in 2019, and the service gets performed in the next accounting period, in this case 2020. So we don't have a particular date, I'll just make one up. So we'll call it the 15th of December 2019. Name of the account, well, at the time this happens, we debit cash $12,000. And you can see slightly different names for this if you look at different companies. But I'm going to call it unearned revenue. Cash is an asset. What unearned revenue is liability. So we have cash going up on the left-hand side, liabilities going up on the right-hand side. And this liability is showing that ATC owes performance of a service. They owe $12,000 worth of service at some future point in time, or if they can't provide that service, they have to refund that money. often you'll see airlines with huge unearned revenue. So again, go and have a look at Qantas, Virgin, and go and have a look at their liabilities, and you'll see a big portion of it is actually unearned revenue. When they actually finally do the work, unearned revenue is reduced because they've performed the work and they don't owe it anymore. And they get to record service revenue, and that is income. So at the time they receive the cash, there is no income effect. You have an increase in an asset and an increase in a liability. When they actually perform the service, that's when they get to show income. The liability effectively nets out over the two periods, and what we end up with is debit cash, credit service revenue. We end up with that same thing that we saw with accrued income, just now the opposite way around. Cash is first, then revenue. But ultimately, it is the same net effect over the periods. The third example is accrued expenses. And in this one, ATC uses a mobile phone for business purposes, and I don't know if they're still using a Nokia 3210. I don't know if you can buy them anymore, but they were a solid phone back in the day. The estimated expenses for December are $500. That seems, they're making a lot of phone calls. The estimated expenses for December are $500 and will be paid in January, with the financial year end being the 31st of December 2019. So at the end of the month, or the year in this case, and we're assuming that they've been adjusting for this all the way along, but let's just assume that we're adjusting just this $500 and they haven't recorded any expenses previously. So at the end of the month, they did have $500 worth of expenses. So we do need to show that. So we have some sort of phone expense or utility expense or mobile phone expense, however you want to call it, 500. And that is an expense item because you have used the phone in December. So that expense should happen in the month in which you used it. But you haven't paid for it yet. So we would show an accounts payable, oh, oops, wrong place, 500. And that is a liability. So that indicates that you have used up something in that particular month and you have a liability because you owe for it. You know, you have used it, you will owe for it, and you will pay for it. In January, at some point in time, you will pay for it. So you will reduce your accounts payable and you will reduce your cash. So accounts payable is a liability. So it increases with a credit, decreases with a debit. If you're doing it in a worksheet, you just show the increase and decrease. It's a liability. And cash is an asset, reduces with a credit, and that's an asset. So at the time where the cash moves, there is no expense effect. An asset gets reduced and a liability gets reduced. And the reason for that is the phone for this transaction, or what we're dealing with, this 500, wasn't used in January. We're talking about the usage in December. And so if we net out accounts payable, we end up with debit phone expense of 500, credit cash of 500. And that is an increase in expense, which decreases equity. So the right-hand side ultimately decreases, and cash on the left-hand side decreases as well. The final example is prepaid expense. And in this one, quite a common one is insurance. So ATC pays a $2,400 12-month premium for public liability insurance, and they do that on the 1st of December 2019. The financial year ends on the 31st of December 2019. When we buy the insurance on the 1st of December 2019, we certainly know cash is going out. So $2,400 going out. But we don't show an expense. We show another asset because as of the 1st of December, you have not used up any of the insurance. That insurance gives you 12 months of coverage from that point on. So all that you're doing effectively is swapping one asset for another asset. You're swapping cash asset for an insurance asset. At the end of the year, we have to make an adjustment. So we look at what we've used up and we record an expense for it. So the insurance expense is 1/12 of the 2,400. Now, you could look at, is it 31 days over 365? I mean, obviously there may be some room to just make it more exact or less exact, depending on what you actually absolutely need. But the important thing is you're only recognizing an expense of 200, even though that you have actually spent 2,400. And prepaid insurance is 200 as well. And this is the asset reducing. So again, at the time where you paid for the insurance, there is no expense effect. When you actually use up the insurance over that month, you get to show an expense and you get to show a reduction in the prepaid insurance. So in this case, we're crediting prepaid insurance, but if you're doing it on a worksheet, you would just show a negative to the prepaid insurance and the same thing would happen. And if we net out some of it, we can't do it all because it's only the first month. But if you imagine this was up until the end of, after a year, what we'd end up with is debit insurance expense, credit cash. Same sort of idea. We're just separating it out, the expense and the cash, over a different set of transactions. And that is 4 different examples on accrued income, income in advance, accrued expenses, and prepaid expenses.